Hey everybody, John King with Summit Funding, and here I am for my weekly Business Booster webinar. So thank you everybody for tuning in. This is definitely one of those moments where the show must go on, as they say in show business. So I woke up this morning with a bit of a head cold, and so I will do my best. We'll make it through this one, but just give me a little bit of grace as I am dealing with this this congestion in my sinuses. So if I sound different, that's why. Anyway. Thank you very much. Looking forward to really helping to educate you today on interest rates and the basics of how they work, the things that you need to understand. And I'm going to talk really high level about interest rates overall, and I'm going to dive into mortgages and explain how mortgage rates work to give you the education that you need to talk to your clients, whether you are a realtor, whether you're a financial planner or a CPA. We're going to have conversations with clients and they are going to say, hey, I don't understand how these interest rates work. And that's really what I want to explain to you today as a big picture explanation during today's Business Booster webinar. So first and foremost, if you have questions, please post them into comments. If you're watching live, I will bring up your comments and I will talk about them. If you're watching recorded, thank you for watching recorded, and feel free to post into comments and I'll follow up with you down the road. So I'm going to go ahead and dive in because we've got a lot to cover, and probably going to make it a little bit shorter than the 30 minutes that I normally do, simply because I have this head congestion and I don't want you to have to deal with me dealing with my sinus issues today. So let's go ahead and dive in and talk about specifically how interest rates are determined. There is so much misunderstanding about interest rates and how they work. The truth is, you've got rates that are as low as, interest rates on the Federal Reserve discount rates had been between 0.25% up until a few months ago for quite some time. And that creates a lot of confusion for people saying, well, I think the Fed is not charging any interest. And so is that what the interest rate is on everything? But you also have interest rates as high as 25 to 30% on a credit card. And how in the world are these interest rates determined, and how do I keep track of it? What makes one interest rate so much higher than another? Why do I pay sometimes 0% interest on a car loan? Sometimes I'm paying 4 or 5% interest, and sometimes I'm paying 25 or 30% interest. And so I want you to first understand the basics of interest. And really it comes down to, what is the money being used for? What is the risk associated with the money that you're borrowing? And what collateral does the bank have if you don't pay? And it's really that simple. Now, when I say what's the money being used for, sometimes there are situations where you might get a 0% interest loan on a car. You can borrow money on a car for 5 years and pay 0 interest on it. Or you get a credit card with a department store or an electronics store that says no interest for the next 2 years if you make your monthly payments and pay it in full at the end of 2 years. Why would a department store or a furniture store or a car dealership give you a 0 interest loan? And it's what is called a concession. And it means that they are giving you a discount. They're finding a way to sell their product to you, and they're not necessarily worried about making money in interest. What they're worried about is making money on the product that they're selling. It's why it's so much easier to get a credit card from a department store, like let's say Kohl's is an example. It's easier to get a Kohl's credit card than it is to go get a Visa. And the reason why is because Kohl's not only makes money on the interest of the credit card, but they also make a huge profit margin on the sale of the clothing. So if you went and spent $200 on a Kohl's credit card and they're charging you 20% interest, that's great. That means that they are earning $40 a year in interest on the $200 that you charged. And if you don't pay them, hey, you know what? That's fine. They get a great tax write-off. They've been charging you 20% interest in the meantime. But the truth is, the $200 that you borrowed, they only spent $100 because that's what the actual cost of the clothing was. So Kohl's has very little to use. And so they are charging super high interest rates on the credit card. They're making money over there, but they're also making money on the sale of clothing. A car dealer says, you know what? I can discount the car and I can give you a $5,000 cashback rebate. But let's target some people who maybe want to get a lower monthly payment. Let's get somebody who maybe wants to get, hey, Kathleen, let's target somebody who maybe wants to get is worried about paying interest on this because they don't have the cash to pay it off. And so let's appeal to those people and charge zero interest. Well, what really is happening is the car dealer is supplementing that interest cost to the bank or to the division of their company that's financing it. And so interest rates are super confusing because you'll see people giving away with zero interest. You'll see interest rates up to 30%. But it has to do with what is their risk. Well, their risk has to do with, hey, did I have to write a check if I'm the Visa? Visa writes a check for the full amount that you bought on your Visa card minus their processing fee. So Visa makes money through a processing fee that they charge the merchant and interest that they charge you. So all of this comes into play when they're deciding how much do I want to charge in interest. And there's a huge range of interest rates. I like to talk about the difference between if you go out and you get a loan for a car loan versus an unsecured personal loan. You're going to get two totally different interest rates there because of the collateral. If you go and borrow $10,000 to buy a used car and you don't make the payment, they can come and repossess the car. Now they got to find the car, but once they find it, they can repossess it and likely sell it for pretty close to what is owed. Versus a personal loan, there's nothing for them to repossess. So they're going to charge you a much higher interest rate because if you don't pay them, they're losing 100% of the money. So collateral and risk has a really, really big piece of what you're going to pay in interest and how interest rates are determined when you're thinking about overall interest across the spectrum of things that you are borrowing. But what I want to talk about now is I want to focus on mortgages. And I want to start by covering some myths about mortgage interest rates and how mortgage interest rates are determined. So the first myth I want to talk about is the Federal Reserve determines mortgage rates. False. People misunderstand. I still have clients literally today saying, oh, I understand rates are higher because the Fed raised rates a few weeks ago. That has nothing to do with it, okay? The Federal Reserve only controls the cost of borrowing money overnight. Literally, the Federal Reserve is saying to a bank, hey, if you need to borrow money to get you through to tomorrow, come to me. I'll loan you the money and I'm going to charge you this low interest rate. But that serves as a benchmark for things like car loan interest rates, home equity loans and lines of credit, and credit cards. And it's through something called a margin. So a margin says, hey, you're getting a home equity line of credit. You're going to pay prime plus a margin. Prime plus a percentage above that. So let's say you're at prime. Let's pretend right now prime is at 4%. You're paying prime plus 3%. That means you're at 7. If prime goes to 7%, then your prime plus 3 becomes 10. That's the definition of a variable interest rate. Anytime you have a variable interest rate, you have an index. Prime rate is a common index. The Federal Reserve, when they move their rate, their discount rate, it moves the prime rate. And the prime rate is a common index for credit cards, car loans, for credit cards and for home equity lines of credit. And then from that index, they add a margin, which is a fixed percentage on top of what the index is, on top of, in this case, what the prime rate is. So the Federal Reserve does not determine mortgage rates. Mortgage rates are determined through lots of other factors that I'm going to get into, but it is not based upon what the Federal Reserve says. All right. So second myth on mortgage interest rates is all mortgage companies have the same rates. That's just not true. And I'm going to use a lot of analogies today. So the first analogy I'm going to use is it's very much like buying a pair of Levi's jeans. The truth is Levi's has a certain cost of manufacturing those jeans, and you can buy those jeans at Kmart. Well, you can't anymore because Kmart's gone. So you can buy them at Kohl's, you can buy them at Macy's, or you can buy them at Nordstrom's. And there's going to be 3 different prices. And Kohl's is going to be the cheapest, Macy's is going to be middle of the road, and Nordstrom's is going to be the most expensive for exactly the same pair of jeans. But it's about the markup, and the markup has to do with the experience of the company you're working with. What are their return policies? How well are they going to take care of you if something goes wrong? The same holds true in the mortgage industry. Now, there's not big differences in cost, but there are small differences in cost. The biggest piece is the actual overhead of the institution that you're working with. Now, if you want to find the absolute cheapest mortgage, you're going to find it by going to a company that is working out of a call center in Topeka, Kansas, that doesn't understand California loans. Let me be clear, loans are not state specific, but there are details about loans like property taxes and homeowners insurance that's state specific. I had somebody last week give me a quote from another bank that was in Topeka, Kansas. And that bank quoted him property taxes at like 0.75% of the property value. Prop 13 in California makes it clear it's 1% plus special assessments. That's an example of where working with someone that isn't local and doesn't have the knowledge can lead you down the wrong road. But their overhead is cheaper. Their cost of doing business is cheaper. And most of the time, the staff that they're using is less experienced. I'd say almost 9 times out of 10. They've got staff that might have been in a completely different industry 6 to 12 months ago. And there's actually, you can look it up online. You can look up somebody's NMLS number and see what their work history was. And you'll typically find that the super, super cheap mortgage companies hire the loan officers that are not seasoned. And when you run into a problem with a mortgage, that non-seasoned loan officer doesn't know how to solve the problem, and you end up running into major issues. More importantly, they're like the order taker at McDonald's. You said you wanted a 30-year fixed and you wanted to pay, the lowest interest rate possible. Guess what? Quicken advertises the lowest interest rate possible, and they charge on average 2 to 2.5 points. And I'll explain points in a couple minutes. There's no need to pay a lot of points, especially in a market where we think interest rates are going to fall again. It's horrible advice to pay a lot of points to buy down an interest rate. But all they understand is people want the lowest rates, and they don't explain to you that there's a lot of extra fee involved in there. So no, not all mortgage companies have the same rates. No, I'm never going to be the cheapest. I'm also not the most expensive. We are super competitive, but don't misunderstand. You are going to see differences from one company to another, very much like you see differences from one gas station to another. They all get the oil from the same place. OPEC charges a certain dollar amount per, it trades. It's a commodity. A barrel of oil is a commodity. The same holds true for mortgage rates. And then each gas station has their own markup. The next is the next myth is that the lowest interest rate is always the best rate. Well, I kind of alluded to this a minute ago. It really has to do with your personal circumstances. I've had times where the smartest thing we've done for somebody is give them a super high interest rate. Because, for example, I had a client who needed a cosigner in order to buy a house. But he knew that in 2 years, his bankruptcy would be old enough that he could refinance and get the cosigner off of it. Excuse me, in this case, it was 1 year. So he knew that he was going to be better off paying a high interest rate with super, super low fees. And Kathleen just brought up an example here. Here's an example. Kathleen says, just like the guy we researched that got into loans 6 months ago. So she and I were sitting with a client the other day, and he was talking about, this person offers a little bit lower interest rate than you, John. And I looked up that guy's license with the client, and the client was shocked to see the guy had only been in the industry for 6 months compared to me being in the industry for 21 years. So experience doesn't come cheap, but you don't pay a whole lot more for it, but you get the right product and the right advice. All right, so lowest rate is not always the best because it has to do with what you're paying in fee to get that interest rate. And sometimes you're better off, if you know you're going to keep this loan long-term, to pay more in fee to get a lower rate. But in the market environment we're in right now, it's highly unlikely. I wholly expect in the next 2 to 3 years, we're going to see interest rates come back down as we hit into a recession. There's no point in paying a lot of fees to get a low long-term interest rate when you're likely going to refinance out of that loan in the near future. All right, so let's switch gears a little bit and talk about mortgage rates. And I'm going to use a lot of analogies comparing mortgages to gas. So when you think about gas prices, and I talked about this a minute ago, you've got the most basic component is the price of a barrel of oil. And that barrel of oil is trading today. So Shell is deciding what they're charging in gas for gasoline that's in the ground at the gas station. They are deciding what to charge for that gas based on how much it's going to cost them today to buy a new barrel of oil to replace the gas that they're pumping into your car. It's the exact opposite for mortgages. We are deciding what does a mortgage that closed 2 weeks ago that's being sold in the mortgage-backed securities markets, what's it trading for? What's it worth? And so we are assuming that it's going to be worth the same in 30 days when we fund this loan. Let me say that in a little simpler way. Mortgage-backed securities are the investment Wall Street places on buying mortgages. It's just like a stock. And when you look on the stock market, it's been super scary in the last couple of weeks. But when you look at the stock market, the stock has a value, and that value is based on what people are willing to pay for it. The more people that want to buy the stock, the higher the value. The less people that want to buy the stock, the lower the value. Mortgages are packaged up into a pool called a security or a mortgage-backed security. And those are sold on Wall Street. That is what determines what your interest rate is. That is the most basic piece of determining a mortgage rate. Now, who buys mortgage-backed securities and why? Any number of Wall Street firms will buy mortgage-backed securities because they are similar to treasury bonds. So treasury bonds are, hey, I have the guarantee of the federal government that they're going to pay a certain percentage. Right now, treasury bonds are paying about 2.75% return on investment for a 10-year bond. So for the next 10 years, you're going to get 2.75%. And at the end of the 10 years, you get your money back. The government gets to use your money for 10 years, paying you 2.75%. But somebody on Wall Street, a bank says, an investment firm says, yeah, 2.75 is pretty good, but I need to make more. I'm willing to take a little bit more risk. I need to make more return. And so they're investing in mortgage bonds because they pay a higher interest rate to the investor. But it's a similar example where, hey, we're going to pay interest over a period of time, and then we're going to get our principal back. So it's really about Wall Street buying these securities is what drives the price or the value of a mortgage-backed security. Now, does the person who buys that mortgage pool, that mortgage-backed security, is that the same company I write my check to every month? No. Your servicer is who you write your check to every month. Super confusing. I'm not going to get too deep into it. But for example, we keep the servicing on about half of our loans, but we don't own the investment on any of them. We sell the pool of investment to Wall Street. And then if we keep the servicing, you pay us every month. We keep a little bit as our servicing income, and then we pass the rest of it on to whoever we sold it to in Wall Street. So who you make your payment to has nothing to do with who actually owns your debt. So here's the simple formula, and it's just like gas prices. So you have what is the rates that the investors want to earn right now for the mortgage-backed securities. It's called a coupon rate, plus the profit margin of the banking institution, plus your risk factors equals your final interest rate. It is that simple. Let me give this to you translated in gasoline prices. So you have what is the price of a barrel of oil, plus the profit margin of that particular gasoline company, and then what type of gas do you want? Is it regular unleaded? Is it diesel? Is it super unleaded? So that's kind of a choice that you control that. What kind of car do you own determines what kind of gas you buy. What your credit score is determines your risk factors on the loan. So the third piece is all about you. The middle piece is about the banking institution you choose to work with, just like the middle piece has to do with the oil company, the gasoline company that you choose to patronize. If you go to Shell or Chevron, you're going to pay a little bit more than if you go to Arco, but there's trade-offs and you have to decide what the benefit is. The biggest thing people misunderstand is you go to Arco, they're going to charge you, what do they charge now? 50 cents for using your ATM card. So it's cheaper per gallon, but they have a bigger upfront fee. That's similar to mortgage companies charging more fees to give you a lower rate. It looks like you're getting a better deal, but you're actually paying more upfront to get that deal. So is it really better? Sometimes, sometimes not. Okay. So you're really looking at what is the value of a mortgage to Wall Street? What is the profitability of that mortgage company, or what's their markup? Again, that's where you'll see a minor difference between me and somebody who has very low overhead and no skilled staff working in Topeka, Kansas. And then the third piece is you and your risk factors. I want to talk about risk factors in a minute, and we're going to kind of wrap up with that. But I want to talk about points for a second. Points is very misunderstood. You always have the option of whether you pay points. There is no exact relationship between how much you pay in points or upfront fee compared with how much you get a lower interest rate. It depends on the market. Again, like gas prices, you typically see about a 10-cent difference between regular unleaded, the mid-grade, and the super unleaded. But sometimes it's 15 or 20 cents in between. The same concept applies when we're talking about buying down mortgage rates and the points that you pay. But the simple thing I want you to understand is paying points on a mortgage is prepaying some interest. You pay me a little bit of money now, and I'll save you money over the next 30 years, assuming you keep the loan for 30 years. The question is cost benefit. How long does it take you to recoup that benefit? You always need to be running that calculation to say, hey, should I spend $4,000 to save $100 a month? Well, it's going to take you 40 months to break even, or 3.5 years. I'm budging there on my math. But the fact is, if you think you're going to have this loan in 3.5 years, it's probably worth paying that. Right now, I don't think people are going to have their loan that long because we think interest rates are going to come back down, and it will likely not pay off to pay those extra fees to buy down the interest rate. All right. So by the way, if you have questions about anything, if you're watching recorded, post them and I will go ahead and comment on them after the fact. If you're watching live, feel free to post questions right now and I'll have time at the end to answer those questions. So I'm going to go through pretty quickly some of the things that determine your interest rate on the mortgage, the risk factors that have nothing to do with the mortgage company you use, what their profit margin is, or what mortgage is traded for. And you're going to be shocked at how many things come into play. The first one is your loan amount. Is it a conforming loan or a jumbo loan, or is it somewhere in between in the no man's land called conventional high balance? Each of those three buckets have a different risk factor and come with different interest rates. Also, you will see different interest rates on FHA loans versus VA versus USDA versus conventional. The type of loan that you do. I have a great example. I was talking to a client today and I said, hey, we're looking at about 5.1% for your interest rate on a conventional loan, or I can give you 4.6% on FHA. Now, it was a trick question. And I said, which would you prefer? And she said, well, I prefer the 4.6. And I said, okay, but the payment on the FHA is $100 more expensive. She said, how in the heck is that true if I've got a lower interest rate? Because the mortgage insurance on FHA is more expensive. So you've got a lot of things that we have to consider. That's where having an expert that understands the market and understands more than just, I'm going to give you the lowest rate, to help you decide what is the smartest thing for you to do. Here's another one that's a major risk factor, the loan term. Is it a 30-year repayment term or a 20-year or a 15-year? The faster you pay back the bank, the faster you expected to pay back the bank, the lower the interest rate is, because there's less risk to us. Every single month on a short-term loan, you pay down your balance faster. So we're going to have less risk. If you can afford to pay a higher payment to lock in a shorter term, you're almost always going to get a lower interest rate. But you do not want to be in a position where you've locked in a short term and now you can't afford the monthly payments. That's actually the worst of both worlds. So be careful when you're thinking about getting a lower interest rate, a lower term on your loan. You're trading a higher required monthly payments. And if you end up being strapped later, now you have to refinance to stretch it back out to 30 years. And you're going to pay fees all over again, and it ends up not being worthwhile. Amortization. Is it a fixed rate or is it adjustable? We're starting to see more adjustable rate mortgages. I am not a fan of them. Sometimes they're a little bit cheaper in interest. I think as we head further into the summer and the winter, we might see more low interest rates on adjustable rate mortgages. But is it low enough to offset what the cost is? Okay. In other words, is it low? Are you saving enough money to take the risk? If you're only saving $50 a month, is it worth saving $50 a month when you only have a guaranteed rate and payment for 5 years? Or would you rather pay the $50 a month higher and have a guaranteed rate and payment for the next 30 years? And that's really what Kathleen says. That's why you shouldn't be so interest rate sensitive. You definitely want the best rate you can possibly get. Don't misunderstand. But it isn't about simply being the lowest rate. It's about the right combination of features. Some people are surprised that you sometimes will see a bank charge a different interest rate on loans used to purchase a home versus loans used to refinance a home. And you definitely see a different interest rate when you're pulling cash out. So if you're deciding, hey, I want to pull cash out of my house, that is a higher risk because you're treating your home like an ATM machine. And the mortgage industry back in 2007 said, wait a second, we had a bunch of people for the last 4 or 5 years that kept cashing out and refinancing their home. And sooner or later, they ran out of equity to pull out of their home, and they tried one too many times and ended up losing their home. So the banking industry looks at cash out as being a higher risk. Loan to value is a significant risk factor for mortgages. The more skin in the game you have, the bigger your down payment, the less risk you have, with one major exception. 20% down has a higher interest rate than 5, 10, or 15% down. And you'd say, John, how in the heck can that be that I'm going to pay a higher interest rate when I put a smaller down payment? It's only true at 20% down, and it's a simple explanation why. Because 20% down is the smallest down payment where the mortgage industry is taking 100% of the risk. When you put less than 20% down, you actually get a better interest rate. But you are looking at paying mortgage insurance, and the mortgage insurance company shares that risk. So again, you got to be careful. Everybody thinks putting 20% down is the best idea. The truth is 20% down has a higher interest rate than 15 or 10% down. So that's where it pays to have an expert on your side. Combined loan to value. Did you know combined loan to value means that you have two loans combined together, or a second mortgage? Fannie Mae considers it a higher risk on the first mortgage when you have a second mortgage on the house. You pay a higher interest rates on your primary mortgage if you have a second mortgage at the exact same time. So it's another risk factor that people did not understand, very rarely understand, goes into the interest rate of the loan. Here's a crazy one. Property state. The state that you are doing the loan in can impact your interest rate. California is a great example. The state of California has limits on how much I can charge you in fees. That means that you cannot buy down the interest rate as much as you might be able to in other states. So theoretically, you could get a better rate in another state than in California, because the California legislature is trying to protect the consumer by not allowing the big bad bank to charge you a whole bunch of fees. But sometimes that backfires, because if you have a small loan amount, the fees we charge to do the work that we do are the same no matter how big your loan is. My company charges $1,525 for the work that we do, whether you're borrowing $50,000 or $500,000. But the state of California says, oh, you can't charge somebody that much money on a $50,000 loan. Well, now I have to bump up your interest rate in order to make enough profit to make it worthwhile to do the loan. That's actually why you very rarely can get a mortgage for less than $50,000, because we simply cannot charge you a high enough interest rate to cover the fees, our cost of doing business, and the state of California does not let me pass along that cost to you. Another risk factor when we look at interest rates, property type. Is it a condominium or a single family home? Is it a duplex, triplex, or 4-unit property? Each of those have different risk factors that Fannie Mae said, hey, we are concerned in a rough market where there's few buyers and lots of sellers, that people are more likely going to want to buy single family homes. The pool of potential buyers across the country, everybody wants a single family home. Very few people want to buy a duplex, triplex, or fourplex. And so in a rough market, those homes can be at greater risk for the bank losing money. So they're going to charge you a higher interest rate, which I just talked about here with 1 to 4 units. Occupancy. Occupancy is, are you going to live in the home or not? Did you know that you pay a significantly higher interest rate for a property that you are not going to live in? Whether it be a vacation home or an investment property, your interest rate is going to be significantly higher. But there is a bit of a loophole. Donald, I saw your question. I'll pull it up in a second. There's a bit of a loophole, and that loophole is if you are buying a home for a parent who cannot afford their mortgage and they're going to live in there, you can actually get primary residence interest rates. So that is an opportunity working with the right lender that can share with you. A couple more here. Big one is credit score. The better your credit score, the lower your interest rates. Credit history. Maybe you have a late payment on a car or on a house loan that might push you to a different type of loan with a higher interest rate. Maximum allowed debt to income ratio. If you're spending more of your income towards your house payment, we might not be able to give you the best program at the lowest rate, so that will determine your interest rate. Same thing with, are we proving assets or not? The more assets you have in the bank, sometimes that makes the loan a lower risk because you have more reserves. Reserves are the rainy day funds you have in case something goes wrong. And some loan programs reward you for having reserves. So there's some really good things here, guys. The last one that I want to talk about is last couple, lock period. The longer we are freezing your interest rate, the higher the cost is, because we have to postpone earning interest on that loan until the end of that lock period. So it's a significantly higher risk. And Donald, to get to your question right now, if anybody else has questions, feel free to post them. The last thing is, are taxes and insurance included in your payments? There is a higher risk to the bank because if you don't pay your property taxes, the county can foreclose. If you don't pay for your insurance, the property can burn down with no insurance. And now we've got a loan on a property that doesn't have insurance. And so you will run into situations where you're going to pay a higher interest rate because you're choosing to pay your own taxes and insurance. Guys, thank you very much. If you have other questions, feel free to post those questions right now. I'll be here for a minute answering them. Donald, you asked this question. You recently did a refi to pull a small amount of cash out. During the process, I got a fraudulent collection report on your credit card. Mortgage company wanted to lend him less and pay points. Do I have legal recourse against a large corporation that places something on my credit that costs me money on my refi? That is a great question. I don't want to speak legally, but I will tell you as a friend, I don't think you have any legal recourse. They thought it was yours. They made an error. Their obligation is to fix the error and remove it from your credit reports. But if it costs you more in the meantime, I have never heard of anybody getting any remedy or recourse from that company. And I've had many people over my 22 years of doing this who have seen that happen to them and gotten frustrated and wanted to go after the company to collect. And I just haven't seen it happen. I encourage you to talk to an attorney, but I have not seen any positive outcome from that kind of a situation. All right, guys, I appreciate you coming in and listening to me today. If you have any questions about this or anything else, give me a holler. I look forward to helping to guide you and anybody that you know. Make sure you subscribe. So right over here, subscribe to my YouTube channel. And I'm looking forward to continuing giving you great information. Have a fantastic week, and we'll talk to you soon. Bye-bye.